increases were needed before the Los Angeles wildfires, and a rate increase is certainly needed now.
Tuesday's hearing in Oakland began with State Farm telling an administrative law judge the company is losing money and in danger of a second credit rating downgrade, which means mortgage companies may not accept State Farm.
If that happens, it would mean that hundreds of thousands of State Farm general policyholders may have to find new insurance. That would send a shockwave through the California market, and it simply wouldn't be possible for many of these homeowners to find new insurance, and they'd be forced onto the FAIR plan.
Last month, State Farm requested a 22% emergency rate increase for homeowners policies. But now they've agreed to reduce that request to 17%. And they brokered a deal for its parent company, State Farm Mutual, to contribute $400 million to a surplus reserve account. The California Department of Insurance is siding with State Farm.
It is not in California consumers' best interest to allow State Farm General, the largest property insurance in California by far with 20% market share, to go bankrupt or to otherwise withdraw from the California market.
If it turns out the emergency rate increase is determined to be too much, ratepayers will get a refund after a full rate increase analysis can be completed. The nonprofit consumer watchdog objected.
Policyholders are not insurance company investors. They don't pay premiums to boost a company's surplus, and they're not here to bail out the insurance company.
State Farm is also requesting emergency rate increases for renters, condo owners, and rental units, increases that Consumer Watchdog says are not backed up by data.
There is no justification for the emergency rate.
Those State Farm rate increase hearings are expected to continue in Oakland through Thursday. If they get approved, the rate increases would go into effect June 1st. David Goffredson, CBS 8.